Your friend buys a random stock. It triples in a week. You bought lunch. That sting you feel? That's not hunger. That's FOMO, fear of missing out. And it's quietly draining more portfolios than bad stock picks ever could. FOMO investing feels like the smart move in the moment. Everyone's talking about the next big thing. The charts are going vertical, and your brain whispers, we're about to get rich, unless we don't act right now. So you buy. And within days, that vertical line is now a ski slope headed straight for your bank account. Why does this happen? Because FOMO investing is emotional investing. And emotions make terrible portfolio managers. When you see people making quick money, your brain doesn't think about long-term value. It thinks about status, about not being the one who missed the wave. The truth? Most waves you're tempted to chase are already breaking on the shore. Here's how this cycle works. 1. The news cycle, social media, and influencers amplify a stock, crypto, or trend. 2. Early movers cash in big. 3. The hype hits maximum volume, pulling in latecomers. 4. The bubble pops, and the latecomers pay for the early movers' vacations. If you've ever bought at the peak, congratulations. You've personally funded someone else's early retirement. Now, is FOMO always bad? Not entirely. FOMO is just your brain saying, something's happening and I don't want to be left behind. That can be useful, but only if you slow it down and fact-check it before throwing money in. The first step to escaping FOMO investing is understanding your risk tolerance. Ask yourself, if this trade goes south tomorrow, will it ruin my mood or my life? If the answer is anywhere near my life, you're gambling, not investing. Risk tolerance isn't about being fearless. It's about being able to sleep at night, even if your portfolio is throwing a tantrum. Second, build an actual long-term strategy. A well-diversified portfolio is like a well-balanced diet. You can have a little dessert, a small speculative position, but you can't live on sugar and hope. If 80% of your capital is in stable, long-term investments, the other 20% can go toward calculated risks without sinking the whole ship. Third, use the cooling off rule. When you feel the FOMO rush, that urgent need to buy something right now, force yourself to wait 24 hours. If after a full day of research you still believe in the investment for reasons beyond Twitter says it's going to the moon, then maybe it's worth considering. This one habit can save you from at least 80% of bad trades. Fourth, remember opportunity cost. When you chase the shiny object, you're pulling money away from other, potentially better opportunities. While you're buying a meme stock at its peak, you might be missing an undervalued company quietly compounding 20% a year. The loudest investments aren't always the best ones. They're just the best marketed. And here's the uncomfortable truth. You can't catch every winning trade. You won't time every bottom or every top. You will watch other people make insane gains without you. And that's fine. Because real wealth isn't built in a week. It's built over decades, in small, boring, consistent moves. History is littered with the wreckage of FOMO. The dot-com bubble of 2000, when companies with no profits traded like they were printing gold. The 2017 crypto boom, when strangers at bus stops pitched you altcoins that no longer exist. The 2021 meme stock frenzy, where $500 million fortunes were made and lost in months. Every time, the pattern is the same. Hype builds, crowds rush in, prices explode, then gravity returns. Here's the irony. Avoiding FOMO often means you do end up catching big opportunities, just in a calmer, more strategic way. By waiting for hype to die down, you can enter at a better price, with less risk and more conviction. Patience isn't glamorous, but it's profitable. One last mindset shift. Stop thinking in terms of missing out, and start thinking in terms of staying in. If you invest with discipline, you're not missing out on this week's flash-in-the-pan rally. You're staying in the game long enough to win the marathon. Markets reward survival. The longer you stay in without blowing up your portfolio, the more compounding does the heavy lifting for you. So, the next time your feed is full of green candles and people shouting, "To the moon," ask yourself, do I want to feel good today? Or be wealthy tomorrow? Because FOMO investing almost always gives you the first and takes away the second.